So first off, the Common Sense Skeptic actually did a very good job evaluating Orbital Assembly as a possible scam. That having been said, his analysis of the financial statements does have some shortcomings and misconceptions that ought to be corrected. So let's get into it.
But it is the last paragraph that should raise alarm bells for any potential investor. To quote the letter, as discussed in Note 2, the company has limited operational activity, has no reliable source of cash flow, and primarily relies on outside funding to maintain its operations, indicating that substantial doubt exists about the company's ability to continue as a going concern. For your information, that is just about the last thing you want to hear as an investor in this company if you put any serious amount of cash in this. This is the long way for accountants to say the company does nothing, has nothing, is worth nothing, and will completely rely on ongoing investor charity, something they expand on in the Note 2 they referred to, which is located on page 9. To quote, the ability of the company to continue as a going concern is dependent upon management's plans to raise additional capital from the issuance of debt or sale of equity, its ability to commence profitable sales of its flagship products and services, and its ability to generate an operational cash flow.
The Common Sense Skeptic appears to believe that the going concern disclosure is the ultimate gotcha when it comes to Orbital Assembly. However, this emphasis is inappropriate when it comes to financial analysis of startups in general, and intellectual property-focused startups in particular. According to the 2020 financials included in their new funding round on netcapital.com, Orbital Assembly was incorporated in 2019. While we are used to entities with default trading cycles of 12 months, some entities have significantly longer production cycles, something which Skeptic failed to account for in his analysis. Imagine for a moment when Facebook was still the Facebook. It took several years of development, which incurred operational running costs, before Zuckerberg was willing and able to monetize the platform and to generate any revenue from it. In those beginning years, Facebook's financials would have looked a lot like those of Orbital Assembly. That is to say that they would have likely had minimal funds in their bank account, and that whatever funding the founders or later angel investors and venture capitalists pushed into the company would have been spent on running costs, and that the asset values would have been comparatively insignificant. In fact, the international accounting standards explicitly prohibit the recognition of internally generated intangible assets, mostly due to the susceptibility of such a valuation to manipulation. That is to say, even the most valuable internally generated intellectual property cannot offset liabilities or share capital on the balance sheet. Yet, as long as the founders or angel investors are willing and able to foot the bill for Facebook's operational costs, development could continue to the point where Zuckerberg became one of the richest people in the world, and where, whatever you think of the ethics of that company, it indisputably had value that investors would have been reasonably willing to pay for, and that paid off to the early investors in the end. That having been said, Orbital Assembly is better compared to a startup in the pharmaceutical industry, as the working capital requirements of a social networking site would have been nothing in comparison to something like Orbital Assembly. While highly unlikely that a new pharmaceutical startup would be able to break into the industry, theoretically, as long as someone was willing to fund it, a product could be brought to market, and the early investment could be very profitable. Of course, keeping in mind that most startups fail, even though at least some of them had potentially viable products.
Keep scrolling past the pie charts and all of the Plenty of Fish profile pictures from their younger years, past the distribution chart, and way down at the bottom of the page is this link to their CPA review letter, which has a bunch of information in it that people who sent them money obviously did not read, as well as their SEC latest offering statement and their articles of incorporation. According to this document, OAC was incorporated in August of 2019, and at the time of incorporation, the company had 100 million shares created at a par value of $0.0001. These documents contain all the details of this prospectus that matter. All of the other stuff on this page is vaporware and smoke.
As such, the recent financials for an entity like Orbital Assembly are largely irrelevant in evaluating whether or not to invest. When valuing a company such as this one would mainly consider the value of intangible assets, whether those are already registered patents or trade secrets or client agreements, as well as any possible synergies. Even the accumulated loss would be an advantage in some sense, as it would create a deferred tax asset. While Orbital Assembly simply does not seem to be feasible, this is not because they have accumulated losses. Orbital Assembly's 2019 and 2020 financial statements do not include any trade creditors, more commonly referred to as short-term creditors by some. Unless it is unlikely that the entity would be able to pay its trade creditors as they become due, which does not appear to be the case here, the presence of a going concern note in a set of financial statements should not be blown out of proportion. Any company who has accumulated losses is automatically supposed to get a note, such as the one included in Orbital Assembly's financial statements, to prevent the CPA from being sued for malpractice.
So let's take a look at the details that all of these anxious investors missed. The Independent Certified Public Accountant Review is a short report, only 10 pages long, and much of it is standard wording with disclaimers and whatnot. It was compiled by Frucci Associates 2 in Spokane, Washington. Orbital Assembly is located in California, so they went out of state for this service. You have to wonder why. This cover letter serves as a disclaimer, stating at the end of the first paragraph that the accountants express no opinion on the company.
The Common Sense Skeptic does not seem to have a clear understanding of the nature of CPA engagements. An opinion can only be expressed by a registered auditor or CPA in the context of an audit. As the company was only incorporated during 2019 according to the financials, it would make sense, particularly financially, to have the financials independently reviewed rather than audited, as the balances and transactions appear to be very simple and few in number. A statement in the report that the CPA does not express an opinion on independently reviewed financials is not only standard, it is required in terms of the international standard of auditing on review engagements. It would need to be there regardless of whether the company is Orbital Assembly or the most promising startup since whoever invented sliced cheese. It speaks to the nature of the engagement, that is to say, the work being performed, not the nature of the company. Orbital Assembly provided audited financial statements for their new funding round. In those financial statements, the CPA's report provided an opinion that the 2020 and 2019 figures and notes represent in all material respects the state of financial affairs, performance and cash flows of the company. While the limited procedures conducted during a review would impact the reliance one would place on the financial statements, the fact that the CPA did not express an opinion with regards to the 2019 financials is not a gotcha by any means. The CPA and the company cannot recommend an investment to anyone. That is not their role, even during a full audit. For a full audit, their job is to perform procedures to determine whether or not the amounts included in the financials and the related notes fairly represent the financial state and performance of the company. Nothing more.
From the top of page 6 of their CPA, it's declared that the company specializes in turnkey construction services in low Earth and cislunar orbit. Additionally, the company provides construction support services and tools to other private space companies and government space agencies. Of course, this statement is complete BS. They have no technology to share, and they have never been to low Earth orbit in any capacity, never mind cislunar orbit. As for the claim that they provide construction support services and tools to other private space companies, that would imply they have agreements in place to supply services they don't have to agencies they haven't disclosed. In fact, we know from John Blinkow during this presentation that SpaceX is not a partner of theirs in any regard, and neither is NASA.
While this did also pop out at us when reading through the 2020 financial statements, this does not actually appear to be a deliberate misrepresentation. The information for that note is typically taken straight from the incorporation documents. This simply defines what is inside and outside of the scope of a particular company's business operations, and it is generally used more to determine whether expenses are inside or outside of the ordinary course of business. So, whether it is tax deductible or whether management is possibly misappropriating assets for personal use. While an additional sentence indicating that sales have not yet commenced would be appropriate, the fact that no revenue has been generated yet is addressed elsewhere, such as the going concern note. Such an additional sentence for clarification would have likely required a deviation from the firm's standard auditing template, and whichever overworked clerk did the drafting possibly has not yet developed the professional judgment to have realized that such a deviation was warranted. One could argue that it should have been picked up during the partner's review of the file, but in the bigger scheme of things, such an oversight would likely be relatively insignificant. What is much more relevant and disconcerting is this.
Remember when Tim said they were going to be delivering the D-Star prototype to their facilities in California? Here's the clip for a reminder.
This machine is currently undergoing commissioning and shipping before final demonstration in our facility in California.
What he meant there was, they're going to rent a warehouse for $70,000 for the demonstration because they don't actually have any facilities.
If someone involved in the management of the entity is indeed making false statements that they are currently assembling something which they aren't, in a facility that they don't actually have, that is to say, if the video of the assembly line was either an outright fake or else intended to deceive investors, that is something that could and ought to be reported to the SEC, who could investigate and who could recommend criminal action for alleged investor fraud. An investigation by the SEC could potentially affect their current and their future ability to fundraise. Now, to take inspiration from the Common Sense Skeptic, and in order to keep the length of this video more manageable, roll the intermission.